Black swans, the topic for today.
Hello, everyone. How are you doing? So, I thought the topic today, I would touch a little on black swans. This topic seems to be cropping up again. Bumpy year in the markets. These things happen. I get it. It seems like every time the market gets volatile and, something unexpected happens, we start talking again about black swans. I've had a whole bunch of questions coming in over the past couple of weeks that are basically, is Monte Carlo software dumb and useless and dead and all these negative terms because it fails to capture black swans and it's not modeling correctly. And so I thought I'd just tackle this topic head on. So, first of all, just to make sure we're on the same page about black swan, because black swan, frankly, has gotten thrown out a lot lately, or thrown around a lot lately, to refer to basically any dramatic event, which is not the point of black swan. Like normal mathematical statistical analysis, like standard math says extreme stuff happens from time to time. That's normal probability theory, right? Like if I keep flipping a coin over and over again, at some point I'm going to flip heads 10 times in a row. That's not a black swan event. That's just because if I do it enough times, eventually I'm going to throw heads 10 times in a row. It's not very probable, but it will happen at some point. So the idea of a black swan comes from the science we actually use to do these sorts of statistical analyses, which is called inductive reasoning. And the idea of it, and this was popularized by Nassim Taleb he wrote The Black Swan, although actually the original book I recommend even more. He put forth this notion, kind of this logic problem. Let's say you've been looking at swans all your life. The definition of swan for most people is a white bird. And that was the kind of the conventional view of all swans until one day we went to a new part of the world and discovered that in parts of the southern hemisphere, there are swans that are black. No one had ever seen a black swan before. And so it leads to this interesting logic scenario. How many white swans would you have to see in order to predict that the next swan is going to be black? And the answer is that that's basically a paradox in statistical analysis. You would never, ever predict you're ever going to meet a black swan, no matter how many white swans you meet, because you've only ever seen one type of swan, and if you literally didn't even know another one existed, you were never going to expect to see it. It would be something that was so improbable, you would have assumed it was impossible, yet it actually was possible, and it happens because there are black swans out there. So that was sort of the origin of the black swan concept. The idea is something that is viewed as being so improbable as to be impossible based on all available data and statistics we have. Yet the truth is, it's actually quite probable. We just didn't know because we were only looking at a small subset of the world and not the universe of all possibility. The classic way this gets manifested in markets is things like when we look at the typical daily volatility of markets and we run our statistical analyses to figure out what's the probability of getting a single day where the market goes down 5 or 8 or 10 or 12 or 15 or 20%, you would actually conclude, since typical daily volatility is only a fraction of a percent, that it's virtually impossible to get a single day market decline more than 4 or 5%. When we look historically, that's happened. We've had 5, we've had 8s, we had 10s during the financial crisis. We had an almost 25 in the crash of 1987. So we get this sort of disjoint where statistically the odds of a single day market crash of 20% should for all intents and purposes be impossible. It's like a 20 standard deviation event, yet it happened. And we've had many that have been 5, 8, 10% declines, even though statistically that should be so rare you would basically never see it once in 100 years, yet we've had a couple dozen of them over the past 100 years. So that's the idea of this black swan phenomenon. And then lots of discussion that says, well, when all these extreme events can happen that we're not accounting for in traditional statistics or traditional distributions, which most Monte Carlo software relies upon, does that basically mean all of our Monte Carlo software is bunk and invalid? And the answer is no. Monte Carlo software really is not invalid as we use it as advisors, for actually a couple of different reasons. The first is just to recognize that this whole phenomenon of black swans it really matters what time horizon you're talking about. So when we look at daily market volatility, what happens as markets go up and down from day to day, we clearly see black swans in the data. You know, statistically speaking, the crash of 1987 was about a 20 standard deviation event, which means mathematically it should occur on average about once every 3 times the length of the universe, which is impossible, yet it happened. However, that's only on a daily basis. When you actually back the frame out and you look instead at what it looks like on an annual basis, here I'll actually give you a chart that I did for one of my articles a couple of years ago. That's what market volatility looks like on an annual basis. So the green line is what a normal distribution would have predicted. The red line is what happens in the real world. Now you notice the red line doesn't perfectly match up with the green one, but that's because the primary problem is actually what's going on over here to the right. Well, I guess technically they're black swans because they were events that were, 5, 6, 7 standard deviation events that weren't supposed to happen and they did, but they were good returns. They're on the right side of the chart. The primary problem we actually see in the historical data of annual returns is not the excess number of bad black swans. It's the excess number of good black swans, or I guess I like to call them golden swans. That's actually the primary problem. In other words, if you're just using annual returns for your Monte Carlo, the biggest problem is you're underestimating the probability that your client has amazing, extraordinary upside wealth, not downside. The downside is actually almost perfectly predicted with a normal distribution on annual returns. It's the upside that's actually not properly predicted. So a lot of this now starts to depend on what your investment time horizon is, what you do. So if you're a hedge fund that's levered a zillion to 1 with banks that settle up every day to make sure they've got sufficient collateral, daily black swans matter. Because if you get a black swan that's a horrible decline today and recovers next week and you're out of business, doesn't really matter. And like the classic example to this in the investment world, that's what happened to long-term capital management. Right? So back in the late 1990s, long-term capital management was incredibly leveraged. They had a black swan event, a convergence or actually a divergence of yield spreads that was never supposed to happen but did. And then as it ultimately turned out, they went bankrupt from the leverage. They had to be unwound. And by the time everything was won around a couple of years later, all their investment debts, or the majority of their investment bets, were actually right. And it got unwound profitably. But they got put out in the business in the meantime because they were so leveraged and mark-to-market daily that they couldn't wait out the volatility. The distinction is, at least for most of us advisors, this is not our clients, right? We don't invest with 5 to 1 or 10 to 1 or 20 to 1 or 50 to 1 leverage that's reconciled daily. Most of our clients have no leverage at all, and they're hardly taking any money, right? Retiree takes 4 or 5% of the portfolio in the year. So if we take a retiree through a scenario like 1987, the crash of 1987, on a daily basis, it was a black swan and leverage funds would have gone out of business. As a retiree, if you took your first distribution on Labor Day of 1987, and then you took your second distribution on Labor Day of 1988, your second distribution came out at a higher price than the first distribution, and you will completely have missed the fact that you had a 20% decline from the crash of 87, followed by a comparably sharp recovery thereafter. And that's just the fundamental distinction of it's not really about black swans, or it's certainly not about daily black swans. At worst, it's about annual black swans, except when we actually look at the data, there are no annual black swans in the market data. And I suppose in the classic definition of black swan, the fact that we've never seen one still isn't proof that we're not going to have one. But still, all this discussion we have about black swans and how normal distributions don't predict them, that's entirely a phenomenon of daily market volatility, not annual market volatility. And for us, that we tend to do withdrawals annually, investment returns annually, we invest for our clients over longer term time periods even than annually. It's basically a nice way of saying black swans don't matter, or don't matter in any way that you would change your modeling. Now, I can still make the case that maybe Monte Carlo software is slightly off because it, maybe slightly overweight, estimates the probability of a, 5 standard deviation annual event, which we'd never seen in the data, but hey, it could occur, it would be a black swan. But you still get this question of what would you actually do with it? So imagine this for a moment. You got a client retirement scenario. You've run your Monte Carlo. The probability of success is 92%. But then I give you this fancy, awesome, brand new financial planning software with great Monte Carlo tools that perfectly predicts actual black swans. So while we think this 5 standard deviation event is impossible and couldn't occur, it correctly identifies the fact that there is a 1.2% probability this would occur, which is 1,000 times more likely than we were giving it credit before. 1,000,000 times more likely than we were giving it credit before. So we rerun our Monte Carlo analysis with this 1.2% possibility of a complete and total catastrophe early in retirement, and the client's probability of success goes from 92 to 91. Now, tell me what you would do differently with your client if you had a Monte Carlo analysis that ignores black swans with a 92% probability of success and a perfect Monte Carlo analysis software tool that correctly predicts the probability is really 91% black swan adjusted. The answer is you're going to do nothing different, right? We don't do anything drastically different for our clients between whether they have a 92% probability of success or a 91% probability of success. It's not a big enough difference to matter. What do we end up doing in practice? If the thing occurs, if the other 8% or 9% bad scenarios occur, we respond, we adjust. That's the whole nature of financial planning. We're working with clients on an ongoing basis. Ideally, our planning software would even give us the tools to analyze this up front. Like, if the market falls 30%, do I need to cut my spending by 5%, 10%, or 20% to get back on track again? That would be formulating a true plan in response to the market decline. But still, ultimately, the best we're going to do is take an event that is extremely improbable. We've acknowledged it could occur, but it's still unlikely, right? The crash of 87 did happen once in the past 100 years, but it only happened once in the past 100 years. You're not going to plan every day assuming that tomorrow could be the crash of 1987, or you're never going to actually generate an investment return, and you're going to be wrong 99.999% of the time and leave all your growth on the table. So the reality really is that planning for black swans isn't about getting better planning software to model them, A, because black swans basically don't exist in annual data, and B, because you wouldn't really do anything different anyways, because even a properly accounted black swan is not material enough to dramatically change a Monte Carlo analysis or a probability of success. What it's really about is formulating the plans about how you're going to respond to it. If the market falls 30%, what would your spending cut be? If the market falls 50%, what would your spending cut be? Or what would your plan be, right? If we know that the reality is most of these things tend to rebound quickly, 5 years later, the financial crisis was making new highs. After the crash of 1987, it took less than a year to make new highs. The plan could actually be, we're going to sit tight for a year and see how much this thing bounces back, because you don't need to touch your money for a year anyways. We've already got spending set aside for a year. Then we'll decide how to respond. And for every 15% of your portfolio has declined, we're going to cut your spending by 5% to keep you on track. That's a plan. That's an actual formulated plan. And now you can deal with that whether you get a normal market decline or a black swan market decline. You formulated a plan on how to deal with the market decline. And to me, that's really the essence of what planning is about. We throw out these black swan labels as though they're so crucial. That's really not what it's about. Not for what we do as financial planning, where our clients are not leveraged to the hilt. They're not doing 10, 20, 50 to 1 leverage like various hedge funds and financial institutions. Most of our clients are unleveraged. They have very little liquidity needs at the end of the day, right? They're spending a couple percent a year. And the truth in that environment is annual black swans both don't exist and wouldn't have a material impact anyways, because clients aren't even withdrawing enough for it to matter. I mean, the truth, even when we look at sequence of return risk, is that it's not big market crashes that actually trigger retirement failures and sequence of return risk. It's bad decades. Because bad market crashes often recover as quickly as they fall, or within a year or a few years, as we've seen in 2008 and 2000 and the crash of 87. Most of the time they recover so quickly, it's hardly even a speed bump. The actual risk for clients in the first place is not bad years, it's bad decades. It's when you retire and 15 years later the market hasn't made any real returns, which is what happened for a retiree in 1929 or 1966. And 66 is a good example. There was no market crash that made that the worst year to retire in the 20th century. It was the fact that you just got mediocre real returns for 15 years because markets were bad and inflation rose and all the dynamics that happen. So just recognize this phenomenon. Black swans are daily events, not annual events. For clients that don't have leverage, you don't really have to care about daily events, and the annual events, you're actually safe. Even if you're going to model them, the probabilities don't move that much, which means you wouldn't do anything differently. All black swans really mean is whether you're going to get a black swan or even a normal, predictable market decline, it's really about formulating the plan. If a decline happens of any material substance, black swan or otherwise, how are you going to adjust spending to stay on track? That's really what it's about for good retirement planning and dealing with black swans. And that's something, ironically, we can't do it very well in Monte Carlo right now simply because the software isn't built to actually show dynamic spending adjustments based on market volatility. Hopefully, we'll see planning software improve in the future in order to do that. But that's ultimately just a modeling issue in planning software and Monte Carlo. It's not actually a failure of Monte Carlo as a tool. So I hope that's helpful as some food for thought around Monte Carlo. I don't know if you guys had any questions about this Monte Carlo Black Swan discussion. I saw a few of you were sharing this out, so thank you for sharing the broadcast as well. But any questions? As Bill Winterberg has chastised me, I have to wait a moment for you to actually type your question if you've got a question. If you're listening in on the from a desktop, I'm sorry you can't ask questions this way. You have to do it through the Periscope app on your smartphone, iOS or Android. That's not me trying to sell Periscope app. That's just the reality of how the technology works. It's not built to do questions from the desktop platform, only from the mobile app. All right, well, hearing no questions, then I guess we'll go ahead and wrap up. Thank you, Bill, for the Happy New Year's wishes. I hope this was helpful food for thought for all of you. Stay tuned for these. I'm going to be doing Periscopes going forward, 1 o'clock East Coast time on Tuesdays, trying to share financial planning topics like this, anything else I can find that's helpful. So have a Happy New Year, everyone. Thanks again, and take care.